I mean, I think there's no question about it. That's what gold's telling you. I mean, what are central banks doing when they're buying gold at $3,000 and not buying treasuries? They're saying that we'd rather own this metal than get 4.5% yield on U.S. Treasury. So they don't trust the treasuries because they don't trust the dollars. So they want to own gold. And this is a process that is still early and has a long way to go to play out. And I think there's going to be a big recession in the U.S., but I don't think it's going to be global because none of the world's factories are going to disappear. They're all still going to be there. And they're still going to sell stuff to America, just not as much as they did.
Gold's recent surge, reaching new highs ahead of Donald Trump's tariffs announcement, highlights a significant shift in market dynamics. Although it has since slipped below $3,100 an ounce, the rapid rise compels analysts to revise their target prices. This surge mirrors the volatile price fluctuations seen decades ago, indicating a notable change in investor behavior. The key driver behind this shift is clear. Rising geopolitical uncertainty and the looming threat of a global trade war prompt investors and central banks to increase their gold reserves. Historically regarded as a safe haven in times of instability, gold's enduring appeal is evident as more market participants seek to protect their assets in an increasingly unpredictable global environment. The factors propelling gold's current climb extend beyond its traditional role as a hedge against inflation and currency devaluation. While these forces have typically fueled demand for the precious metal, gold's price remains relatively stable during the pandemic's inflationary period. Only now, as inflationary pressures ease, will gold experience significant gains. This suggests that more complex dynamics are at play, particularly when considering the broader economic context and the shifting global landscape. A potential explanation for gold's rise could be the corresponding decline of the US dollar. Since the beginning of the year, gold has increased by 20%, representing a near doubling if extended annually. In contrast, the US dollar has fallen by about 6% against a basket of global currencies. This decline may be attributed to the unpredictable nature of Trump's policies, especially his tariff strategies and the growing volatility in global markets. As confidence in the US dollar wanes, gold emerges as the preferred alternative for investors seeking stability. Peter Schiff, a prominent economist and advocate for gold, frequently points out that the increasing dollar weaponization, alongside Trump's policies, accelerates this trend. Schiff suggests that as global uncertainty rises, gold becomes an increasingly attractive store of value, further eroding faith in the US dollar. Schiff's analysis underscores the shifting global economic dynamics as this trend unfolds, highlighting how gold is growing more appealing than ever. We present the clips of Peter's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
I mean, gold is above 3,100. We're right near record highs. We set that record high last night, but gold's going up. It's going to keep going up. This is dedollarization. It's just the central banks that have been driving it up. We haven't even gotten the real investor demand yet. That's coming. Retail investors in the U.S. are going to be buying gold, but they're going to be buying it at much higher prices. They're going to be buying silver too at much higher prices. This is a de-dollarization. The dollar is going to go down. I mean, today the dollar is down by over 2% against other fiat currencies. It's one of the biggest moves down in one day in the dollar that I can remember. One of the biggest ever. And this is just the beginning. So many people were predicting that the tariffs would cause the dollar to go up. And they thought that would take the sting out of the tariffs because, yes, we'd have to pay the tariffs, but we'd get to buy the foreign goods cheaper with our higher dollar. Well, instead, the dollar is falling, and that's going to augment the damage done by the tariffs. So not only are Americans going to have to pay tariffs on what they import, but what we import is going to cost us more because of the weak dollar. So, it's a double whammy. Well, right. Gold is just noise. It's just a bunch of trading going on today, the shakeout. Bonds are rising today, but I think that's temporary. I think bonds are going to fall because inflation is going to erode away their value and a reduction of demand due to a weak dollar is going to lead to lower bond prices. And of course, as the US economy goes deeper into recession and we get larger budget deficits, that increases the supply of bonds to sell, and we have fewer demand for those bonds. Meanwhile, what no one's talking about is over the next 4 years, about 26 trillion of the 36 trillion national debt matures. So all that debt has to be rolled over. Who's going to buy that? So bonds are going down. The only thing that's going to stop that is the Fed going back to QE. But even that'll be temporary because that will create even more inflation, which is the worst thing for bonds. I think the dollar has been the source of, our artificial economy. We've been able to live beyond our means because we can export dollars to pay for goods. I think that's the process that's going to be reversed. And Trump accelerated it with the tariffs. I mean, I think there's no question about it. That's what gold's telling you. I mean, what are central banks doing when they're buying gold at $3,000 and not buying treasuries? They're saying that we'd rather own this metal than get 4.5% yield on U.S. Treasury. So they don't trust the treasuries because they don't trust the dollars. So they want to own gold. And this is a process that is still early and has a long way to go to play out. You can't price in risk that you don't perceive. That is the problem. The markets don't see how much risk there is. That's just like, remember with the subprime market, which I was short for, the subprime market, they were pricing these bonds above par when in my mind they were worth zero. Now, why was the market pricing them? Because they didn't perceive the risks that actually existed. And the same thing is happening in the treasury market. There's a lot of risk out there that investors just don't perceive. And so if you don't know the risk is there, you can't price it into your models. But once people start to recognize this risk, it will be priced in. That's why bond prices are going to crash. So a lot of people are also talking about a global recession because of these tariffs. And I think there's going to be a big recession in the US, but I don't think it's going to be global because none of the world's factories are going to disappear. They're all still going to be there. And they're still going to sell stuff to America, just not as much as they did. So what does that mean? That means they have extra stuff to sell to consumers in other countries. And as those currencies are rising relative to the dollar, those consumers are richer anyway, and they can afford the products. So I think the world is not going to have a recession because of this. I think it may even have a boom because, what they have to do is very simple. They just have to find new consumers for what they're already producing. And there's billions of people around the world that are happy to consume. Anybody can consume. But what America has to do is build factories out of nothing. So because we can't consume if we don't produce. And so starting to produce what we haven't produced is much harder than consuming what you already produce. So we're the ones that have the rough road ahead. We're going to be enduring the recession. So I think selling commodities based on fears of a global recession are wrong. The U.S. is going to have a recession, but our loss is going to be the world's gain. And so I think demand is going to be very robust for commodities around the world. Even if it's diminished here in the U.S., it's going to be a lot higher outside.
Peter Schiff has issued a stark warning about the future of the U.S. economy. He believes that the country is on the brink of a financial disaster that could surpass the 2008 crisis. Schiff criticizes government leaders and financial media for overlooking key economic indicators that suggest serious trouble is ahead. Drawing comparisons to the lead-up to the global financial meltdown over a decade ago, Schiff argues that similar blind spots and missteps are occurring again. According to him, the combination of rising tariffs, trade disruptions, and rising inflationary pressures will trigger a chain reaction that could destabilize the economy. Schiff's warning highlights the growing risks and the urgency of addressing these economic challenges before they spiral out of control. Schiff is particularly concerned about the tariffs imposed under the current administration, which he believes will severely disrupt trade flows. He argues that fewer goods will be imported, leading to higher domestic prices as more money chases fewer goods. This will create inflationary pressures across the economy, with the rising prices of imports pushing up demand for domestically produced goods, thereby causing even higher prices. Moreover, Schiff predicts that the decline in trade deficits will result in fewer dollars being recycled into U.S. bonds, driving long-term interest rates higher. Schiff explains these developments will hurt both consumers and financial markets, as higher consumer prices and rising interest rates will significantly strain the economy. Additionally, Schiff criticizes the Federal Reserve's likely response to these economic challenges, warning that further monetary easing in the face of inflation will only exacerbate the situation, causing even more inflation and weakening the dollar. Schiff's analysis presents a sobering view of the potential impact of these policies, underlining the need for careful consideration of their long-term effects.
The tariffs hit right away, right? But the tariffs aren't paid until the goods are imported. And if you noticed, our trade deficits in the U.S. for the past few months have been off the charts. And so what I think is that a lot of companies saw the tariffs coming and they ordered some inventory. So they have to work that inventory off first. So those products can be sold without the tariffs. Now, I think they will raise prices somewhat because they realize that this is their last chance to make money. Because once they run out of those goods, they have to pay the tariff on the new goods, and their customers probably will be priced out of the market, a lot of them. So you'll start to see some initial increases in prices, but it won't fully hit until they run out of stuff. And, there's going to be a mad dash. I mean, some people are going to rush to the stores and, they're going to buy new sneakers, for example. Maybe they'll buy 3 or 4 pairs, knowing that, they're going to wear out. They'll want to get another pair. They're going to wear out because all those sneakers are going to get so much more expensive. So some of these companies, could see a rush of sales, now until they use up what they got. And then their business is going to dry up, substantially. We're going to be reversing a process that, has on the surface been benevolent, but it really wasn't if you understood it. But now it's going to be very sinister. See, what's been happening is we create inflation, printing money. We export it to the rest of the world, and they ship us the stuff that they make. So we have goods to buy, and the money goes abroad. And so that keeps prices down, and we get more stuff. Then the foreigners take the dollars they earn and buy our bonds, buy our stocks. That gives us lower interest rates and a higher stock market. So we get wealthier on paper, we get to borrow cheap, and we get all kinds of consumer goods we didn't produce, and they're low cost, right? What's going to happen now is all that inflation is now going to move from Wall Street back to Main Street. We're not going to have as big trade deficits anymore. So we're not going to be able to export as much of our inflation. It's going to stay here. We're going to have more money chasing fewer goods. So a big increase in prices. Foreigners are not going to buy as much U.S. stocks and bonds. So we get a lower stock market and higher interest rates. So that's the reverse of what we've been enjoying, right? And so it's going to be the worst, thing for Americans because they're going to be getting poorer financially as their cost of living is skyrocketing. And many Americans are going to lose their jobs. So we're going to go through the worst economy in modern memory. Now, I don't think anybody alive today has seen an economy that's going to be as bad as this one. Now, it may get better eventually. Maybe we get the benefits of AI and stuff like that. But in the short run, things are going to get very, very bad. And that's horrible for the Republicans because, Trump just blew them up. I mean, the Democrats were in disarray. The party was really in shambles, and this is going to galvanize them because Trump is going to be the villain that did this. They're going to be able to say he inherited a great economy, which he didn't, but then he destroyed it. And the Republicans are going to be out of Congress in the midterms. I mean, the Democrats are going to get the House and the Senate.
As global uncertainties continue to mount, the future of gold looks increasingly promising, with the precious metal poised to reach even greater heights. Gold's recent surge past the $3,000 mark clearly reflects the growing shift in market dynamics, where rising geopolitical tensions and shifting economic policies are making gold a go-to safe haven for investors. This trend is expected to gain momentum as central banks build their gold reserves, and demand for exchange-traded funds, ETFs, tied to the metal remains robust. As we look ahead, gold will likely see its price rise further, with projections pointing to a potential $3,300 per ounce by the end of 2025, driven by strong fundamentals in investor sentiment and institutional demand. Gold is expected to remain a defensive, anti-fragile asset amidst rising uncertainty. With U.S. policymaking becoming more unpredictable, the precious metal's appeal is expected to grow stronger. As trade tensions escalate and inflationary pressures continue, the demand for assets that can weather economic storms, such as gold, is likely to increase. That's it for today. Share your thoughts on Peter's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.